What's up everybody, Gen X Dividend Investor here. In this video I answer a commonly asked question, which is if dividends have historically outpaced inflation, and I think you'll find that the details behind the answer are quite fascinating. I'll also tell you about a family reunion I recently attended, and how a discussion I had about investing turned controversial. So if that sounds interesting to you, then please show your support by hitting that thumbs up button, subscribing if you haven't yet, and clicking that bell notification. Okay, I'll kick this off sharing parts of a white paper I found on the sec.gov site, written about a year ago by a bunch of professional financial analysts, which begins with a section about the importance of dividends, and then continues on talking about how dividends have done versus inflation. It starts by saying, historically dividends have been a meaningful component of equity total returns. While the proportional impact to total returns from dividends varies meaningfully in the short term, over the long term, the significant benefit from the compounding effect of dividends' stable and consistent return stream is undeniable. This is illustrated in Figure 1, which shows the median rolling 1-year contribution from dividends of 15% versus the median rolling 30-year contribution of nearly 40%. They go on and say, over the last 20 years, dividends have grown to account for greater than 50% of the total income generated by a 60-40 balanced portfolio. In fact, dividends have accounted for greater than 50% share of total portfolio income for most of the last decade. So TLDR, dividends matter and are a material source of your stock returns. The article continues on by saying, dividend growth has outpaced CPI inflation in the post-World War II period, and in every decade except the 1970s. Companies that grow their dividends provide an effective inflation hedge to portfolio income streams, an attribute that bond income does not provide. This graph they shared depicts dividend growth versus inflation by decade. The y-axis are percentages and the x-axis are decades. Dividend growth is represented as blue rectangles and inflation is in red. So like in the 1940s, the average dividend growth for stocks in the S&P 500 was a little over 6%, whereas inflation was around 5%. Then in the 50s, dividend growth averaged around 5%, whereas inflation fell to around 2%. In the 1960s, dividend growth was a bit under 6%, whereas inflation was a bit over 2%. Then in the 70s, we see a switch where inflation was around 7% versus dividend growth was less at 6%. In the 80s, dividend growth went ahead at 7% versus inflation at 5%. In the 90s, dividend growth was around 4% versus inflation at 3%. In the 2000s, dividend growth was around 4% versus inflation at 2.5%. And in the 2010s, we see dividend growth shot up to 10% after the financial crash versus inflation at under 2%. So clearly dividends grow more than inflation does, on average. Okay, and beyond dividend growth, let's also look at how much dividends were part of total returns over the decades as compared to inflation rates, and this chart I found on a Fidelity article highlights things. The article says, dividends have accounted for 40% of stock market returns since 1930, and 54% during decades when inflation has been high. When inflation has been high, the stocks that have increased their dividends the most have outperformed the overall market. Dividend payments may help make a stock's total return less volatile. It then showed this graph of S&P 500 returns by decade. The light blue rectangles represent how much return was attributed to stock price movement, and the dark blue rectangle shows how much return came from dividends. The golden diamonds represent what inflation percentage we were at in each decade. One thing that might pop out to you is that in the 1930s and in the 2000s, the light blue rectangles are below the 0% line, which means stock appreciation was negative in those decades. But dividends are always above the 0% line because dividends have always had positive returns, regardless of what stock prices did, which is another thing I love about my dividends. Stocks might crash, markets might blow up, whatever, and my dividend cash keeps flowing into my bank account. So like in the 1930s, dividends returned about 2%, but stocks fell 5%, and inflation was around negative 5%, which means deflation. During the Great Depression, deflation was the result of a collapsing financial sector and bank failures. The deflation that took place at the outset of the Great Depression was the most dramatic that the US has ever experienced. Prices dropped an average of nearly 7% every year between 1930 to 1933. Then in the 1940s, we see that stock appreciation was finally positive at around 3%, whereas returns from dividends was 7%, and inflation shot up to over 15%. In the 1940s and 1970s, when inflation surged, dividends accounted for 65% and 71% of the S&P 500's total return, respectively. So the next time someone tells you dividends don't matter, you can just smile and know better. Okay, and going back to the original article, it continues on by saying, a healthy and growing dividend is a sign of a stable business with a strong balance sheet and a consistent ability to grow earnings. Investors often view a dividend as a sign of management's confidence in the future growth of the business and its commitment to shareholders. Unlike other accounting-based measures of profitability, dividends are difficult to manipulate. A dividend policy focused on the sustainability and regular growth of a dividend is often rewarded by the market through higher valuations. This can have the effect of disincentivizing management teams from speculative investments that may endanger free cash flow and erode shareholder value. A prudent dividend policy can result in a company being less susceptible to the negative effects of a recessionary shock. They make a bunch of great points in that blurb, so let's go over it carefully. It starts with saying that a healthy and growing dividend is a sign of a stable business, which is why one of the metrics I want to see in my dividend stocks is at least 10 consecutive years of dividend increases, along with a decent CAGR. They go on to mention the importance of a strong balance sheet and consistently growing earnings, i.e. companies that have positive cash flow, income-generating assets, more assets than liabilities, an appropriate amount of debt, the ability to fund operations while striking a balance between liquidity and profitability, etc. And then back to the article, they also said that dividends are difficult to manipulate, so there's something that you can put your trust in more. Then they continued on by explaining that a company that regularly grows their dividend is often rewarded by share appreciation in the market. Additionally, the fact that management is paying dividends and needs to keep paying them can cause management to be careful to not invest stupidly in speculative things that might negatively impact their free cash flow. Finally, they say that a good dividend policy can result in a company being less impacted by economic recessions. Awesome. Another section of the article says, dividend-paying stocks have outperformed non-payers with less risk over time. They show dividend payers averaging 13% annualized returns in the time frame they measured, whereas non-dividend paying stocks were at 11.75%. Nice. Now, a common recommendation from professional financial analysts is to own your own agent bonds as a percentage of your portfolio. So like if you're 60, then you should own 60% of your portfolio in bonds. The reason for that is because as people move closer to the age at which they plan to retire, they should replace the risks of their stocks with their usually more stable bonds. Most bonds pay a fixed interest rate that becomes more attractive as interest rates fall, driving up demand in the price of the bond. Conversely, if interest rates rise, investors will no longer prefer the lower fixed interest rate paid by a bond, resulting in a decline in its price. These days, a more modern recommendation is the 15-50 stock rule, which says that if you think you have more than 15 years left to live, your portfolio should consist of at least 50% stocks, with the remaining 50% in bonds and cash. The goal of that approach is to try to maintain a steady balance between risk and reward. Personally, I'm pretty conservative, but I'm not a fan of bonds, and I'm okay taking the risks with my companies. Historically, stocks have outperformed bonds over the long term. Like a starting investment of $100 in stocks in 1929 would have been worth more than $761,000 at the end of 2021. A $100 corporate bond investment on the same timeline would have been worth $54,000, and treasury investments would have been worth even less. So while stocks have historically outperformed over long time frames, bonds can help protect your portfolio from shorter-term downturns. Another reason I go more aggressive with no bonds are charts like this one about dividends and inflation in bonds from 1972 to 2016. The figures in the bars represent the portion of total return that can be attributed to income return and price return. And while stocks and REIT prices tend to be volatile, dividends serve as a stable component of total return and may provide better inflation protection compared to bonds. Between 1974 and 1980, which was high inflation, the average rate of inflation was 9.3%, much higher than the historical rate of 4%. During this time, bonds yielded 8.4% from income, but prices declined by 2.7%, resulting in a total return of 5.6%, way short of inflation. On the contrary, stocks returned a total of 10%, i.e. 5% from dividend income and 4.8% from price return, outpacing inflation for this time period. The income return of REITs alone was 10.4%, higher than the 9.3% rate of inflation. REITs as a whole returned a total of 17.9% for this time period. So nothing is guaranteed, but I'm happy to stick with my decent dividend stocks, and you need to go with what makes sense to you. Some very successful people only invest in bonds, so take that for what it's worth. Anyways, I found another interesting article on a wealth management site which showed this graph of classic inflation hedges that included gold and treasury bonds, and showed how their long-term return potentials have sucked compared to dividend stocks. So when inflation is higher, gold and T-bills can act as a hedge, but as inflation retreats as it historically has always done, then good dividend stocks have delivered stronger risk-adjusted returns over time. Thus, good dividends give you both some inflation hedging with their income streams, and often give you some great long-term returns. Win-win. I found another interesting article that said that, quote, moderate inflation is generally good for equities because it tends to be associated with positive economic growth, rising profits, and stock price gains. However, things can quickly turn ugly for stock market investors if the economy overheats and inflation rises too high. Our research has found that equities outperform inflation 90% of the time when inflation was low, below 3% on average, and rising. But when inflation was high, above 3% on average and rising, equities fared no better than a coin toss, as shown in the chart below. They also said that equities should offer a buffer against inflation because a rise in prices should correspond to a rise in nominal revenues and, therefore, boost share prices. On the other hand, this may be offset by a contraction in profit margins given an increase in companies' input costs." End quote. That being said, in my experience, companies almost always raise prices more than their costs, so in high inflationary times they're often making even more profit. Like trucking companies often add a fuel surcharge to transportation invoices when gas prices are high, but what many people don't realize is that those companies frequently raise prices more than their increased cost of gas, i.e. they turn the negative of higher gas prices into an opportunity to profit even more. And sure, you could get annoyed by that. Instead, I'd just recommend that you invest intelligently so that you win no matter what happens in the economy. Finally, and lest there be any doubt, I found this article on Blackrock, which analyzed stocks from 1871 to 2021, and what they found was that inflation averaged 2% annualized over that entire time frame, but dividend growth averaged 3.7% annualized over that time, almost double inflation. And that's just dividend growth, it's not accounting for stock appreciation, which means even more returns. So to close this out, I'll include this final blurb from Dividend.com that sums up things nicely. It says, "Dividends provide investors with an important layer of protection against inflation. Simply put, as more dollars are required to purchase a particular good or service, more dollars are paid for that particular good and service. Thus, more dividends should be passed along to the investor in a commensurate fashion, assuming that inflation is uniform and the payout ratio is consistent." End quote. So if you think about it, if inflation is going up, that simply means that the prices you're paying for goods and services are going up. And if you own great companies, then that probably means your companies are the ones that are raising their prices due to the higher costs they're experiencing themselves, from the cost to gather resources to the cost of turning those resources into products, etc., etc. Companies almost always win, which is another reason why you want to be an owner in addition to being a consumer. That way, when inflation goes up, you're at least benefiting in some fashion, instead of just feeling screwed by something out of your control. I've always looked for the positive in whatever was happening in life, rather than tunnel vision on the negative. That doesn't mean be ignorant, it just means be positive, as that'll make you happier, or at least less unhappy. Life can be tough, so be an owner, don't just sit in the stands. And to definitively answer the question I originally posed, yes, dividends have historically outpaced inflation on average. Okay, now I want to shift gears and tell you about a family reunion I attended, where the topic of investing came up and the ensuing discussion highlighted a disagreement we had. It all started with people talking about how amazing ChatGPT and generative AI was, which led us to speculating about a future where AI and robotics and automation were advanced enough that almost no humans would be working at places like Starbucks or McDonald's or as delivery drivers, etc. We figured that a lot of people would lose their jobs, and unlike previous technological advancements in history, we thought that there would end up being a net job loss instead of a net job gain, like we've always previously seen. I mean, we recognize that there would be some new jobs created to build and maintain automation, but we believe far more jobs would be displaced than ultimately created, leading to a material greater level of unemployment, and that would probably eventually lead to some sort of job displacement taxation on the companies that automated away the jobs, and then those taxes would need to be used to fund some sort of universal basic income. Now sure, it's also plausible that as robots and AI become more prevalent, then the need for actual human interaction will increase, leading to a series of new jobs being created that we can't even imagine right now. Regardless, it also wouldn't surprise me if the future was totally different than that, so don't get your panties in a wad if you think UBI is evil or whatever, as that's not the main point of this. What is the main point was that I think that investing becomes an even more important aspect of your financial planning, to act as a hedge against potential job loss, either yours or your kids or your grandkids or whatever. You'll want to actually own useful, productive, cash-flowing assets, like dividend stocks and real estate, instead of relying on your skills which might be automated out of existence. Our thought was that the rate of automation will far surpass anything we've seen in history, which also means jobs will be displaced at a faster rate than ever, so ensuring that you have cash flowing in from something other than your skill set becomes even more necessary. Now, one of the couples in the discussion we were having agreed that the importance of owning cash flowing assets becomes even more important, and in fact their primary source of income in retirement was from a mini mall they owned. Their story was that he used to work as an engineer and his wife used to be a mortgage broker. Over the years, they slowly invested in real estate, and their biggest win was from buying some land and building a big house on it, which they sold and then used the profits to buy a mini mall. Fortunately, the pandemic didn't hurt their commercial real estate investment too much, and they were now enjoying retirement by traveling the world, paid by their main asset. But then a different couple in the discussion, i.e. the folks actually hosting the dinner, said that they didn't own any cash flowing assets, and the husband said that some people like himself couldn't invest. And that's where the disagreement came from. He was complaining that his parents had never pushed education, and if they had, then he'd have been more successful in life and he could have invested. Now, everyone has different challenges they face, and everyone has problems, some being much worse problems than others. Some people get unlucky, some people are born into poverty, some people are born with health afflictions and other really challenging situations, all of which can impact their ability to succeed. But I'm a fan of figuring out how to succeed, even with the hurdles thrown your way. I don't like blaming your parents on your lack of success. And I knew this guy wasted money on a bunch of unnecessary things, like super expensive pets. It wasn't that he couldn't invest, it's that he didn't prioritize it relative to other places he spent his money. And his comment about not being able to invest is actually one I frequently hear from those that don't invest, and while I know that there are periods where you might not be able to invest, I think that if you push it you can figure out a way. It might not be much, but it'll be something, and small things can blossom into big things over time. And with that I'll end things, and I'll normally do a shout out to my newest Patreon aristocrats and kings, but I'm still all sold out. So instead I'll recognize and thank my all-star Patreons, i.e. those supporters that have been signed up to my Patreon for over a year and continue to stay on board. Also, I'd like to thank Seeking Alpha who sponsors me. My favorite part of Seeking Alpha's premium membership is the access you get to all the stock articles in their associated comments section. There's a lot of gold in that information, which is why I paid for Seeking Alpha membership for years. Whatever you do, please hit that thumbs up button, subscribe if you haven't yet, and click the bell notification. And I highly recommend that you join my free Dividend Discord chat server, which has over 10,000 Dividend investors on it from 76 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.